Welcome back to BullionIQ, the channel where we talk about crypto, money, and financial markets from a real expert point of view. If you are here just for hype, rumors, or emotional price predictions, this channel is not for that. But if you want to understand what is really happening behind the scenes, how institutions move money, and how regulation shapes the future of digital assets, then you are in the right place. Today's update is extremely important for every XRP holder because what just happened is not a normal crypto headline. This is a regulatory development that changes how major financial institutions can legally operate with digital assets in Europe. And more importantly, it shows us where real adoption is actually going. Ripple has just confirmed that it has secured preliminary electronic money institution approval from Luxembourg's financial regulator known as the CSSF. Now, on the surface, this may sound like boring legal paperwork. But in the world of finance, this is exactly the kind of approval that opens doors to banks, payment providers, and regulated institutions. This is not marketing hype, this is compliance. And compliance is what allows large money to move. If you follow Ripple and XRP, type an X in the comments, hit the like button, and stay with me till the end, because we are not just talking about what happened. We are breaking down why this matters and how it impacts the long-term future of XRP. For years, most of the crypto market has been driven by speculation. Prices go up because of excitement, social media narratives, or fear of missing out. But institutional finance does not work that way. Banks, financial service providers, and global payment networks cannot operate on hype. They need regulatory clarity, licenses, and legal frameworks before they integrate any technology. Without those, adoption does not happen at scale. That is why today's development is so powerful. Ripple is not being pushed away by regulators. It is being welcomed into one of the most advanced financial jurisdictions in Europe. According to Ripple's own release, the company now holds more than 75 licenses and registrations worldwide. It has already processed over $95 billion in volume and touches around 90% of daily foreign exchange markets. These are not future promises. This is real infrastructure already being used at scale. And now with the European Union building a clear regulatory framework for digital assets, Ripple is positioning itself directly inside the system rather than outside of it. Most investors misunderstand what real adoption actually looks like. They think adoption starts when price pumps. In reality, adoption starts when governments, regulators, and financial institutions officially integrate technology into their legal and operational structures. That is what is happening here. Ripple is moving from pilot projects into real commercial level deployment. This means institutions are no longer just testing. They are preparing to use this technology in actual financial operations. Luxembourg is not just another country. It is one of Europe's most respected financial hubs, known for strict compliance standards and sophisticated regulation. When a company receives preliminary EMI approval there, it means regulators are comfortable allowing that company to handle electronic money and payment infrastructure. This is not something given easily. This approval allows Ripple to scale its digital asset infrastructure across the European Union. In simple words, it gives Ripple legal access to build payment systems for institutions inside Europe, and this is where XRP becomes central. Ripple is not just trying to make payments faster. The real goal is to modernize how value moves across borders by connecting traditional banking systems with blockchain-based liquidity. This is about transforming outdated, slow, closed financial systems into real-time, always-on global networks. When regulators approve this framework, they are giving financial institutions the green light to start using it, and institutional money does not move without regulatory permission. This is why regulation is not bad for crypto. In fact, regulation is what unlocks serious capital. Without regulation, you get speculation. With regulation, you get integration. Ripple right now is doing what very few crypto projects have managed to do, working with regulators while still building blockchain-based financial infrastructure. That combination is exactly what large financial institutions demand before they commit resources. You also need to look at the bigger strategic picture. Europe is no longer experimenting. It is actively positioning itself as a global center for compliant digital finance. By approving Ripple in both the UK and Luxembourg, European regulators are sending a clear message. They want blockchain technology to be part of mainstream finance, not something operating on the sidelines. That is a huge shift in how digital assets are viewed at the highest levels. For XRP holders, this matters because XRP sits at the heart of Ripple's settlement and liquidity model. As institutions move from proof-of-concept projects to full production systems, they require deep liquidity, regulatory certainty, and reliable infrastructure. These are exactly the areas Ripple has been building for years. This is not about short-term price movements. This is about positioning XRP inside the regulated financial system. Most people only notice transformation after prices explode. But in finance, the real change always begins quietly with licenses, regulatory approvals, and infrastructure development. Then one day, the market suddenly realizes that a new system is already in place. That is where we are right now. This Luxembourg approval is not just good news, it is a signal that the foundation for institutional adoption is being laid. This is why I wanted to put this on your radar, not because of hype, but because of structure. Not because of speculation, but because of integration. If you understand how financial systems evolve, you know that this is exactly what the early stages of a major shift look like. In the next part, I will break down what this approval actually enables in practice, how it connects Ripple to Europe's banking network, and what this means for the future role of XRP in global payments. Because this is where most people get confused. A license is not just a stamp of approval. In finance, a license defines what you are legally allowed to do, who you can work with, and at what scale you can operate. When Ripple receives preliminary EMI approval from Luxembourg's CSSF, it means Ripple can begin operating as a regulated electronic money institution within one of Europe's most respected financial jurisdictions. That opens direct pathways to banks, payment service providers, fintech companies, and cross-border settlement networks across the European Union. In simple words, Ripple is no longer just a technology company offering blockchain solutions. It is becoming a regulated financial infrastructure provider. This is a massive distinction. Most crypto projects build products and then hope institutions adopt them. Ripple is doing the opposite. It is building infrastructure that fits directly into existing regulatory systems. That means institutions do not need to bend the rules or take legal risks to work with Ripple. They can integrate Ripple's technology while staying fully compliant with financial laws. This is especially important in Europe because the European Union operates under strict financial regulations. Banks and payment companies cannot simply plug into unregulated systems. They need legal clarity around custody, settlements, electronic money handling, and cross-border transfers. With EMI approval, Ripple can legally facilitate electronic money operations and build payment rails that are compliant across EU jurisdictions. That is what turns experimentation into real adoption. Now let's talk about how this connects to XRP and the underlying technology. Ripple's payment infrastructure is designed to bridge traditional banking systems with blockchain liquidity. At the core of this system is the ability to move value instantly across borders without relying on slow, expensive correspondent banking networks. Instead of routing payments through multiple intermediaries, Ripple's technology allows institutions to settle transactions in real time using digital assets as a liquidity layer. XRP plays a critical role in this model by acting as a neutral bridge asset that can convert between currencies quickly and efficiently. What makes this different from other crypto use cases is that Ripple is not trying to replace banks. It is integrating directly into banking infrastructure. The goal is not disruption for the sake of disruption. The goal is modernization. Legacy financial systems are slow, fragmented, and expensive. Cross-border payments can take days and involve multiple intermediaries. Ripple's model compresses that entire process into near-instant settlement while remaining compliant with financial regulations. This is where the earlier proof-of-concept projects in Europe become important. As Ripple has demonstrated, European payment systems can already connect regulated banking rails to blockchain-based liquidity using technologies like the Interledger Protocol and the XRP Ledger. This allows euros to move from traditional bank accounts, settle through blockchain infrastructure, and reach their destination without altering the existing SEPA framework. In other words, banks do not need to replace their systems. They can connect to a new layer of liquidity that operates on top of what already exists. That is a powerful concept. It means adoption does not require a complete overhaul of the financial system. It requires integration. The European payments network is massive. Thousands of institutions operate under SEPA, covering dozens of jurisdictions. When Ripple gains regulatory approval in a hub like Luxembourg, it gains the ability to offer its infrastructure to this entire ecosystem in a compliant way. That is how network effects begin. One regulated gateway leads to multiple institutional connections. Those connections lead to transaction volume. Volume leads to liquidity. And liquidity is what gives digital assets real utility. This is why the market often misreads developments like this. Many investors look for immediate price reactions and assume that if the price does not explode, the news must not be important. But institutional finance moves in phases. First comes regulatory approval, then comes infrastructure deployment, then comes gradual onboarding of institutions. Only after that does large-scale capital begin flowing through the system. We are currently in the infrastructure and regulatory phase. Ripple already operates across more than 75 jurisdictions. It already processes billions in volume. And now it is embedding itself deeper into Europe's regulatory framework. This is not a company preparing for a short-term market cycle. This is a company positioning itself for long-term relevance in global finance. You also need to understand the strategic value of Luxembourg itself. Luxembourg is not just another European country. It is a financial center for banking, fund management, and international payments. Many global institutions base their European operations there specifically because of its strong regulatory environment and cross-border financial expertise. By securing approval in Luxembourg, Ripple is not just gaining access to one market, it is gaining credibility across the entire European financial system. From an institutional perspective, credibility matters more than marketing. Banks do not care about hype on social media. They care about whether a company is licensed, compliant, audited, and legally permitted to operate. Ripple is checking those boxes. That is why this development matters so much more than speculative partnerships or announcements. For XRP, the implication is structural. If Ripple's infrastructure becomes embedded in cross-border payment flows across Europe, XRP's role as a liquidity bridge becomes increasingly relevant. The more institutions that rely on this infrastructure, the more demand exists for efficient, neutral settlement assets. This is not about retail traders buying and selling on exchanges. This is about real money moving between institutions in real time. This is also why regulatory clarity is the real catalyst for long-term value. Without clarity, institutions stay on the sidelines. With clarity, they can deploy capital at scale. Ripple's expanding regulatory footprint is not just good news for the company. It is a signal that digital asset infrastructure is being accepted into mainstream finance. The most important takeaway here is this. What we are seeing is not hype-driven growth. It is system-level integration. This is how financial revolutions actually happen. Slowly at first, through policy, licenses, and infrastructure, then suddenly through widespread adoption. What is happening right now is not limited to one country or one region. Around the world, financial institutions, regulators, and even central banks are actively studying how digital assets and blockchain technology can be integrated into the existing monetary system. The old infrastructure is slow, expensive, and fragmented, and everyone at the institutional level knows it needs modernization. One of the most important trends we are seeing globally is the push toward real-time settlement. In traditional finance, moving money across borders can take days, involve multiple correspondent banks, and generate high costs. This is inefficient in a world where information moves instantly. Institutions want value to move the same way data does. That is why so many central banks, payment networks, and financial authorities are exploring blockchain-based settlement systems. Ripple's approach fits directly into this global shift. Instead of trying to replace the financial system, Ripple is building a bridge between traditional banking and digital asset infrastructure. This is exactly what regulators and institutions prefer. They are not looking for disruption that creates chaos. They are looking for controlled modernization that improves efficiency while maintaining oversight, compliance, and financial stability. That is why Ripple's strategy of working closely with regulators is so important. When we talk about central banks discussing digital assets, we are not talking about speculative cryptocurrencies. We are talking about infrastructure that can support cross-border payments, interbank settlements, and liquidity management at scale. The fact that financial authorities in Europe have openly explored models that connect regulated banking systems with blockchain networks tells us something very important. Digital assets are no longer being treated as experimental. They are being evaluated as components of future financial architecture. This is where XRP's role becomes strategic rather than speculative. XRP was designed specifically for fast, low-cost, cross-border value transfer. Unlike many digital assets that focus on decentralized applications or niche use cases, XRP is optimized for liquidity and settlement. In Ripple's model, XRP can act as a bridge currency that allows institutions to move between different fiat currencies instantly without holding pre-funded accounts in every jurisdiction. That solves a major inefficiency in the global financial system. From an institutional perspective, this is extremely attractive. Banks and payment providers currently need to maintain Nostro and Vostro accounts around the world to facilitate cross-border transactions. This ties up capital and creates friction. A digital bridge asset that can source liquidity on demand reduces the need for that trapped capital. It improves balance sheet efficiency, it lowers transaction costs, and it speeds up settlement times. These are exactly the outcomes financial institutions are trying to achieve. Now combine that with regulatory approval. Without legal clarity, even the best technology cannot be used at scale. Institutions cannot risk operating in uncertain regulatory environments. But when a company like Ripple receives formal approval in major financial hubs, it removes that barrier. It signals that regulators are comfortable with the technology and its compliance framework. That is what allows banks and payment providers to move from testing to implementation. This is why the Luxembourg approval is not an isolated event. It is part of a broader trend where Ripple is steadily embedding itself into regulated financial systems across multiple regions. The UK, Europe, and other jurisdictions are not just allowing Ripple to operate. They are giving it the legal framework to expand. For XRP holders, this matters because it changes the nature of demand. Most of the crypto market is driven by retail speculation. Traders buy because they expect price appreciation, not because they need the asset for operational use. Institutional demand is different. Institutions use assets because they solve real business problems. If XRP becomes integrated into payment flows as a liquidity tool, demand for XRP is tied to transaction volume, not market sentiment. That creates a fundamentally different value dynamic. Think about it this way. If a digital asset is only traded by speculators, its value depends entirely on narratives and cycles. But if a digital asset is used as part of financial infrastructure, its value is linked to usage, liquidity needs, and network effects. As more institutions use the system, more liquidity is required. As more liquidity is required, the asset becomes more deeply embedded in the financial ecosystem. This is exactly how traditional financial infrastructure gains importance. Payment networks, clearing systems, and settlement layers are not exciting to retail investors, but they are essential to the functioning of global finance. Ripple is positioning its technology, and by extension XRP, in that layer of the system. Another key point that many people overlook is that regulatory clarity also attracts institutional partners. When a company is licensed and compliant, it becomes easier for banks, fintech firms, and financial service providers to justify partnerships. Legal teams, compliance departments, and regulators all need to be comfortable before any integration happens. Ripple's expanding list of approvals makes those conversations possible. This is why we are seeing a gradual but steady increase in institutional interest around blockchain-based payments. It is not happening overnight. It is happening through frameworks, pilots, and now regulatory greenlights. That is how serious financial change always unfolds. At the same time, governments and financial authorities are under pressure to modernize payment systems. Cross-border commerce, global remittances, and digital trade all require faster, cheaper settlement. Blockchain-based solutions offer a path forward, but only if they can operate within legal and regulatory boundaries. Ripple's strategy is designed specifically to meet that requirement. From a long-term investment perspective, this is what you want to see. Not just announcements, but alignment between technology, regulation, and institutional demand. This is not about predicting the next short-term price move. This is about understanding where the financial system itself is evolving. We are watching the early stages of a structural shift in how value moves globally. It is not loud, it is not flashy, but it is real. And projects that secure a place inside that structure stand to benefit in ways that most speculative assets never will. Market structure, and the future role of XRP inside the global financial system. Because at the end of the day, the real question every investor has is not just whether adoption is happening, but how that adoption can translate into real demand and long-term value. First, we need to understand how institutional liquidity works. In traditional finance, liquidity is not driven by emotions or speculation. It is driven by necessity. Banks, payment providers, and financial institutions need liquidity to settle transactions, manage risk, and operate efficiently. When they move money across borders, they must either pre-fund accounts in multiple currencies or rely on slow correspondent banking networks. Both options tie up capital and increase costs. Ripple's infrastructure is designed to solve this problem by providing on-demand liquidity through digital assets. Instead of holding large amounts of capital in different countries, institutions can use a digital bridge asset to move value instantly between currencies. XRP was built specifically for this purpose. It is fast, low cost, and designed for high volume settlement. This makes it fundamentally different from assets that are primarily used for speculation or decentralized applications. When Ripple secures regulatory approval in major financial hubs, it creates the conditions for this model to be used in real operations. Institutions can legally integrate the technology into their payment systems. Over time, as more institutions adopt the infrastructure, transaction volume increases. And as transaction volume increases, so does the need for liquidity within the system. This is where long-term demand for XRP can come from. If XRP is used as a bridge asset in payment flows, demand is not based on traders buying and holding in the hope of price appreciation. Demand is based on operational usage. Every transaction that requires conversion between currencies through XRP creates a need for liquidity. As the network grows, that liquidity requirement grows with it. This is how infrastructure assets gain value over time. However, it is important to be realistic. This process does not happen overnight. Financial institutions move cautiously. They start with limited use cases, test systems, assess risk, and gradually scale up. That is why regulatory milestones are so important. They remove the biggest barrier to adoption, which is legal uncertainty. Once that barrier is gone, integration becomes a business decision rather than a regulatory risk. This is also why you often see a disconnect between positive fundamental developments and short-term price action. Markets are driven by sentiment in the short term, but by structure in the long term. Structural changes in finance take time to reflect in market value, but when they do, the impact can be significant. Another factor that matters here is network effects. Payment systems become more valuable as more participants join them. If Ripple's infrastructure continues to be adopted by banks, payment providers, and financial institutions across multiple regions, it creates a network where value flows more efficiently through a shared system. XRP, as a liquidity bridge within that system, benefits from that expansion. Think about how traditional financial networks gained importance. SWIFT, for example, is not exciting from a retail investor's perspective, but it is critical to global banking. Its value comes from its network. The more institutions that use it, the more essential it becomes. Ripple is attempting to build a modern alternative for real-time settlement, and it is doing so within regulatory frameworks rather than outside of them. This is why the long-term conversation around XRP should focus less on daily price charts and more on integration, volume, and institutional participation. If XRP becomes embedded in payment infrastructure, its relevance is tied to economic activity, not market cycles. That is a fundamentally different type of asset. Of course, this does not mean there are no risks. Adoption depends on institutions actually choosing to use the technology. Competition exists from other payment solutions, including internal bank systems and alternative blockchain platforms. Regulation, while necessary, can also evolve in ways that introduce new requirements or constraints. No financial system changes without challenges. But what sets Ripple apart is its strategic positioning. It is not trying to bypass regulators. It is working directly with them. It is not building in isolation. It is integrating with existing financial structures. That gives it a level of legitimacy that very few crypto projects have achieved. From a market structure perspective, this also changes how you should think about XRP as an asset. Instead of viewing it purely as a speculative token, it makes more sense to view it as a potential component of financial infrastructure. Infrastructure assets are not valued based on hype. They are valued based on usage, reliability, and scale. If Ripple continues expanding its regulatory footprint and onboarding institutional partners, we could see a gradual shift in how XRP is used. More volume moving through real-world payment corridors, more liquidity being sourced through the asset, more integration with banking and financial platforms. Each of these developments strengthens the asset's role within the system. This is why patience is essential in developments like this. The biggest transformations in finance are rarely explosive at the beginning. They start with policy changes, regulatory approvals, and infrastructure projects. Then, as systems become operational and usage grows, the market begins to recognize the structural shift. We are still early in that process. The Luxembourg approval is not the final destination. It is a building block. It adds another regulated gateway for Ripple to expand across Europe. It reinforces credibility with institutions, and it strengthens the foundation for future integration. For long-term holders, the key is not to get distracted by short-term noise. The question is not whether the price moves tomorrow. The question is whether XRP is becoming more deeply embedded in the financial system. And based on the regulatory progress, the answer is that Ripple is steadily moving in that direction. What we are seeing with Ripple in Europe is not just a company expanding into a new region. It is an example of how digital assets are slowly being absorbed into the structure of traditional finance. This is not the kind of change that happens through hype or speculation. It happens through licenses, regulations, compliance, and infrastructure. That is exactly what Ripple is building. For years, the crypto market has been dominated by short-term thinking. People chase price movements, react to headlines, and often confuse noise with progress. But if you look at how real financial systems evolve, the pattern is always the same. First comes regulation, then comes infrastructure, then comes institutional adoption. And only after that does the market fully price in the transformation. We are currently in the first two phases. Ripple's expanding regulatory footprint shows that governments and financial authorities are no longer viewing blockchain-based payments as experimental. They are treating them as part of the future financial system. This is a major shift in mindset. When regulators create frameworks for digital assets and grant operational licenses, they are effectively saying that this technology is here to stay. This is also why it is important to separate projects that are building real infrastructure from those that are driven mainly by narratives. Infrastructure projects are not exciting in the early stages. They require patience. They involve long approval processes, legal reviews, and gradual integration. But once they are embedded, they become difficult to replace. That is where long-term value is created. XRP's potential is directly tied to this process. If Ripple's payment network continues to be adopted by banks, payment providers, and financial institutions, XRP's role as a liquidity bridge becomes more relevant. Not because people are speculating on price, but because institutions need efficient ways to move value across borders. That is a fundamentally different type of demand. As an investor, this changes how you should think about positioning. Instead of asking only where the price might go next week or next month, the more important question is whether the asset is becoming more useful inside the financial system. Utility, integration, and compliance are what drive sustainable adoption. If those factors are strengthening, the long-term outlook improves regardless of short-term volatility. This also has implications for the broader crypto market. We are entering a phase where regulation will play a much bigger role in determining which projects succeed. Not every crypto asset will be able to operate within regulated financial environments. Some will remain in speculative or niche use cases. Others will adapt, comply, and integrate. Over time, this will likely create a divide between infrastructure-based digital assets and purely speculative ones. That does not mean speculation will disappear. Markets will always have cycles, but it does mean that projects with real-world integration will have a different kind of foundation. Their relevance will not depend entirely on market sentiment. It will be linked to usage, partnerships, and institutional trust. Another important point is that global finance is under pressure to modernize. Cross-border payments, remittances, trade settlements, and financial messaging systems all face demands for speed, transparency, and cost efficiency. Blockchain technology offers solutions, but only if it can operate within legal and regulatory boundaries. Ripple's approach is designed specifically for that reality. This is why developments like the Luxembourg approval matter far more than they might appear on the surface. They show that a path exists for blockchain-based systems to become part of mainstream finance. They show that regulators are willing to work with companies that prioritize compliance. And they show that the conversation is shifting from if digital assets will be used in finance to how they will be used. For XRP holders, the key takeaway is not to expect instant results. Structural change takes time. Financial institutions move slowly because they manage risk at scale. But once they commit, they do so in a way that can reshape entire markets. That is why early infrastructure positioning is so powerful. It sets the stage for future growth long before the market fully recognizes it. At the same time, it is important to stay balanced and realistic. No investment is guaranteed. Adoption depends on execution, competition, and evolving regulation. But what you want to see as an investor is progress in the right direction. Regulatory approvals, expanding infrastructure, and institutional engagement are all indicators of that progress. What we are witnessing is the gradual integration of digital assets into the financial system rather than their exclusion from it. That is the bigger story. Not price spikes, not social media hype, but the construction of a new financial layer that blends traditional systems with blockchain technology. This is why I wanted to walk you through this in depth. Not to create excitement, but to provide clarity. Not to push narratives, but to explain structure. Because in the long run, understanding how the system is changing is far more valuable than reacting to every headline. If you are following this space seriously, focus on the fundamentals. Watch where regulation is moving. Watch which companies are gaining institutional trust. Watch where real money is building infrastructure. That is where the future of this market will be shaped. We are still early in this transition, but the direction is becoming clearer. Ripple's regulatory progress in Europe is not an isolated event. It is part of a broader shift in how digital assets are being incorporated into global finance. And XRP sits right in the middle of that conversation. Let me know your thoughts in the comments. Do you see this as a turning point for institutional adoption? Or do you think the market is still underestimating what is being built behind the scenes? If you found value in this breakdown, support the channel by liking the video and sharing it with others who want real analysis instead of hype.